chapter addresses internal control and financial reporting for cash and for merchandise sales. Now, both those things, cash and merchandise sales, have a pretty high control risk associated with them because, number one, they're easily stolen or potentially easily stolen and then usable by employees and others. And so you have to be quite careful in how you control those assets. That's what this chapter is all about. Once again, we'll take a look at the chapter through a number of learning objectives. This time I believe there are 7. The first learning objective is to distinguish among service, merchandising, and manufacturing operations, because it's actually a pretty significant difference in terms of how you design and implement internal controls. First of all, in a service company, the operating cycle consists of selling a service. And so you perform a service, you collect for that service, and you also incur operating expenses for that service. So that's the typical operating cycle of a service company. Notice there are no inventories involved here generally, except for maybe the use of some supplies and stuff. But typically, what you've got is you've got people performing a service for a service company. So for a merchandising company, the operating cycle consists of selling products, like tangible stuff, and then you collect the cash for the sales. You do incur operating expenses like you do in just about any operation, and then you again buy products that you resell and start the cycle all over again. So there are inventories involved here. Inventories of products. Products are things of value that somebody wants. So when you have those types of physical items, you run the risk of having somebody take them from you, by stealing them or misappropriating them in some way. The operating cycle of a manufacturing company is like that of a merchandising company, in that you're selling products and you're collecting cash and you're incurring expenses. But now you're actually having to buy raw materials and convert those raw materials into a product. And that's what you sell. So you're selling a product that you make. So you not only have your finished goods inventory once you've completed making the product, but you've got other inventories as well. For example, the materials inventory, and that also has a value. And so you've got additional control issues if you happen to be a manufacturing company. So learning objective number 2 is to better understand the principles and the limitations of this thing we call internal control. So let's take a look at this thing we call internal control. As part of operating activities, about every company I've ever encountered has some type of procedures in our policies built into it that involve internal control. Internal controls are the policies and procedures that are put into place in an organization for these 4 purposes. Number 1, to protect against the theft of assets. That includes cash and the inventory that we sell and use to make things that we sell. Number 2, enhance the reliability of the accounting information. In other words, we control who has access to the accounting records and who can change those records, and we have different approvals in place for that type of thing. All of that is intended to enhance the reliability of the accounting information. Number 3, promote efficient and effective operations. That means only certain people can approve things, certain people can perform certain operations, that type of thing, to enhance the effectiveness of operations. And finally, there are controls in place to help us ensure compliance with laws and regulations, because that violation of certain regs and laws can shut a company down in a hurry. So we build controls into place to make sure that we follow laws and regulations in an organization as well. So each of those 4 things are what internal controls are put into place to help them. So let's take a look at an example of some common control control principles and their explanations. So principle number 1 is to establish responsibility. In other words, if there's a problem, we need to have a specific person to go to follow up on that problem. So we assign each task to only one person. The example given here, each Walmart cashier uses a different cash drawer. So if you're a cashier at Walmart, you have a cash drawer, you're responsible for the cash in that drawer. If there's a problem with that drawer, we know who to go to because we established the responsibility for that drawer. Second, segregate duties. That means that one employee should not be responsible for all parts of the process. In other words, again, taking the Walmart example, if there's to be a price change or adjustment at the register, the cashiers who bring up these sales can't approve these price changes. They have to call the manager to come over and approve something like that. So we've segregated those duties. The duties are bringing up sales and approving some kind of a price difference. We also restrict access in internal control. We restrict access to of important things and areas to a certain level of employee or management. And so, for example, again at Walmart, the cash and access to its computer systems are restricted to different levels of employees by the use of passwords and firewalls and that type of thing. And then document procedures. Or you could look at this either as document procedures, in other words, what are the procedures and how should they be documented so you know how to follow them, or even in terms of specific documents, what are the procedures involving each of your documents. So you have documents to show activities that have occurred. When you pay for something at Walmart, you pay with a check. You have a document, for example, a check. Walmart pays their suppliers using pre-numbered checks so that they can account for all the checks that were written for a period and they know that's the case. The same can happen with invoices or purchase orders, that type of thing. Finally, independent verification is a control principle. That means we check one another's work to make sure that it's both correct and, I guess, honest in some ways. And so one of the examples here, Walmart compares the cash balance in its accounting records to the cash balance reported by the bank. And they make sure that those are either the same or that they can explain the differences through a bank reconciliation. Then we'll be doing bank reconciliations as part of this chapter as well. So internal controls can never be absolute because there are ways that they can be circumvented, or sometimes the controls that would need to be put in place in a certain area just aren't worth the cost. So we have to do a cost-benefit analysis to make sure that the control that we want to implement is actually worth doing that. And there's also the possibility of either human error or fraud in an organization. Somebody can be very good at working around controls in order to steal from an organization. It can just be an error, or two or more people can collude to defraud an organization. For example, in the Walmart example, let's say you've got a buddy who's a manager, and that buddy gets a cashier job, and the two of them work together to give friends price breaks, where the manager comes and approves a price break for one of the buds at the register, or approves refunds, that type of thing for stuff that shouldn't be approved. So there's ways through collusion to get around internal controls as well. So learning objective 3 is an application objective. In other words, we want to figure out how to apply the principles we just talked about to cash receipts in an organization and cash payments in an organization. So cash is a biggie in internal control because there's usually a lot of cash around in organizations that sell things, and cash is owned by the person that possesses it. In other words, there's no title to cash that you have to prove. Once you have it in your pocket, you can spend it. It's not like stealing a painting and then having to find someone to sell the painting to and then get the cash. You've got the cash in your pocket once you take it. So let's look at cash received in person, by a person like a cashier or something like that. We have to segregate the duties involved with that cash collection and reporting so that one person doesn't take the cash, have access to it during the process and then report the amount, because what they could do is take in cash, take some of it out, put it in their pocket, report the amount, and nobody would know that there's anything missing in between. So the cashier takes in the cash from the customer. Custody of the cash once it's in the drawer is usually a manager or somebody like that, because the drawer gets taken and counted at the end of the day, and the recording of the cash happens through a scanner or a cash register or something like that. So you can always compare what's in the drawer to the sales that were recorded. So let's take a look at this a little bit more in detail. You've established responsibility by having a cashier that's responsible for a particular cash drawer. You segregate duties by not having that cashier able to approve price changes or refunds and that type of thing. You also restrict access. A cashier can't just open a cash drawer. It has to be associated with a particular transaction generally. And documenting procedures in this particular case is the cash register actually records the amount of sale when items are scanned. Then you account for that through the cash drawer that goes right into the accounting records, and so those sales amounts can be independently verified because you can compare the cash drawer and a cash count sheet to what should be there based on what was rung up through the scanning of the different items that were sold for the period of time, whatever that happened to be. And so a supervisor restricts access to the cash drawer and also can do an independent verification. When cash is counted in the cash drawer and put in this cash count sheet, it is also counted by another person. So two persons, or at least two people, sign off on the amount of cash that was counted for verification purposes. And then the daily cash receipt summary is combined of all of these cash sheets for all the drawers in the place, and they get verified, compared to, again, by another person, the accounting records that come from documenting the procedures through the different cash registers and whatnot.
There's no sound on this part for a while.
I'll just tell her.
Yeah,
Say
I
that.
did.
Oh.
I was like, no sound.
Sorry, and you switched me early. I had that.
I was like, it's a good place to switch.
Oh crap. I forgot to ask Nikki if she wanted lunch.
Oh. And she's done at 12. 12:30.
She is not like that.
Is she coming back over here?
Not until like 30 minutes.
I know, but you'll like talking. Da, da, da. This,
I
I
was just not
remember
worried
seeing
about it.
this, it's like a long.
We also have cash that can be received from a remote source. In other words, people send us checks through the mail, sometimes even cash, or we receive cash through electronic payments and that type of thing. And we also have to build controls around those. Now, there are pretty specific controls that need to be built into these. Right now, your job is just to realize that these situations exist, and a more in-depth study of internal control would explain the controls involved there. We're going to stop the internal control discussion here and then move on to looking at a bank reconciliation as another means of control for that involved in that process we just talked about, where we're taking cash into an organization through sales. So whenever there's cash in an organization, cash comes in through sales in one way or another. One of the most basic and important controls involved is performing a bank, what we call a bank reconciliation. That's where we compare the amount of cash that's reported in our accounting records to the amount of cash that actually is in the bank. That's called a bank reconciliation. We're going to look at those now. Okay, a bank reconciliation is basically a process where you compare what's in your accounting records to what shows up in the bank records. So you get two separate sets of records. First of all, banks can provide services by restricting access to cash. And so, in other words, you put money in the bank, it's safer there. It's harder to get at for people who want to take it from you. By documenting procedures, because you've got deposits and you can track those deposits and check writing and all that type of thing, and independently verifying. You can confirm the amount of cash you've got from the bank by looking at bank statements or requesting what we call a bank confirmation. And that is an independent verification of the amount of money that you have. So bank reconciliation is something we prepare internally to verify the accuracy of both the bank and our accounting records, because mistakes can be made in either one of these places. So we compare the book balance, our balance, our accounting record balance, to the bank's balance, and we explain the differences. Because of timing issues, there will generally be differences, and we have to be able to explain and verify those differences, because if we can't, then we most likely have an error or some other kind of problem. So let's take a look at a typical bank statement. There are 5 things that show up in a bank statement that are important in the reconciliation process. You've got the balance as of the last statement. You've got checks that came through the bank and were paid, in other words, cleared the account. Number 3, you've got deposits that were made, and then you have other transactions, and finally you have an ending balance. And so balance last statement is what your ending balance was last month. It's now the beginning balance this month. You subtract the checks that actually were paid by the bank for the bank. You add the deposits that were made, that made it to the bank before the end of the month. And then the bank usually has other things on that statement that you might not know about yet. And that would be the interest that might have been earned on the account, whether there was a check returned. In other words, you made a deposit, but somebody wrote you a bad check, so it gets subtracted from your account. Whether there was some kind of electronic funds transfer for some reason, or service charges. Those are all things we need to account for in our records, and we do that usually as part of this bank reconciliation process. And then finally, there's the ending balance for this one that we compare to our accounting records after we've taken into account all of the timing differences that could exist. So the bank reconciliation is really about reconciling the differences between your accounting records and the bank records. There are some things you don't know about that the bank knows about. There are some things that you know that the bank doesn't know. So for example, what the bank might not know is whether or not they made an error, and you could tell that from your records if a check that was actually written for one amount got subtracted by the bank for another amount, and that will happen sometimes. Also, there are time lags involved. You might have made a deposit on the 31st of the month, but the bank didn't actually record it until the 1st, so when you get that bank statement, that deposit will show up in your records, but it won't show up in the bank statement. That's something you would know about that the bank didn't know about at the 31st, and so it didn't show up then. And checks, there also may be what we call outstanding checks. Those are checks that you've written before the end of the month, and so they're in your accounting records as reductions to cash. But they didn't get back to the bank, and so they hadn't been subtracted from the bank balance until after the end of the month, so they would be in the next month. And so those are differences, timing differences, that we would know about, but the bank didn't know about. What we might not know about is if the bank put interest into our account for whatever the balance was before, and we generally don't know that until we see the bank statement. So that interest, that amount of cash and the interest revenue that goes with it, wouldn't be in our records, but it would show up on the bank statement, so we would need to make a correction for that. Electronic funds transfers might not show up on our records unless we had knowledge that the transfer was going to happen, so that's a possibility. Also, the bank oftentimes charges service charges and takes them out of our account on a monthly basis. And we don't know what those are usually, again, until we see the bank statement, so we would have to record those then in our records as well. And again, like we said, customer checks that we deposited that bounced, so the bank would subtract them back out of our balance, but we didn't know that yet, and so we wouldn't have subtracted them out of our balance yet. And then sometimes we make errors that we discover when we're doing this, and so we wouldn't know about that until we do this reconciliation. So simply put, what we're doing is we're looking at our bank statement on the left-hand side of this slide. We're comparing it to the ending balance in our cash account, signified by the T account on the right-hand of this slide. And we see a difference, and we have to be able to reconcile the two to make sure that we understand what the difference is, and that we're comfortable that the amount in our cash at the end of the month is correct. We will generally end up making some adjustments to that cash account as part of our bank reconciliation process. So the goals of doing a bank reconciliation are, well, there are four of them. One, to identify deposits in transit. In other words, there are going to be deposits, cash amounts that we recorded that don't show up on the bank because we deposited them probably on the last day of the month, and they haven't gotten to the bank yet, or the bank hadn't recorded them yet, and so we will have to, that will help us account for part of the difference. Number two, identify the outstanding checks. What checks have we written before the end of the month that haven't gotten to the bank and been subtracted by the bank by the end of the month? Those are outstanding checks. We need to identify what those are because it's part of our reconciliation. Three, record transactions that are on the bank statement that we haven't recorded yet. That would be the interest we earned maybe from the bank or service charges we incurred that we hadn't recorded yet because we just saw them on the bank statement and they need to be recorded. And finally, determine the impact of the errors that might have been, that we might have made, and make corrections for those errors. And of course, if the bank made an error, we have to have the bank correct the error on their side as well. So as part of this bank reconciliation, we'll just take a look at these journal entries and make sure we feel comfortable with them. For example, if the bank pays interest and puts that interest into our account, but we haven't recorded it yet, we would have to make that adjustment. And so you can see here, that would be, we would debit cash to increase our cash to reflect the interest we just earned for 20 bucks, and we would credit interest revenue to reflect the revenue from the interest we just earned. Also, if we received an electronic funds transfer from a customer and we didn't know that the customer had transferred funds, we would have to record those. Again, we would debit cash and we would credit accounts receivable because that customer would have charged something from us, and this would be their payment of the receivable. If a customer's check, if we deposited a check and recorded that cash, and then it turns out that the check bounced, the customer wrote a bad check, what we have to do is we have to remove that amount from cash because we'd already recorded it in our cash account. So we would debit accounts receivable because that customer still owes us that money, and we would credit cash reducing our cash by the amount of the check that bounced. The reason we debit accounts receivable is because when we got the check in the first place, we debited cash and credited accounts receivable, thinking they were paying us what they owed us on account. But since the check bounced, they hadn't paid us, and so we have to put that receivable back again. We have to restore the receivable. Finally, if there are service charges from the bank, we have to record those. And so, we incurred $6 for a checking account charge. We would have to debit some kind of expense. Here we're calling it office expense. And we would credit cash to reflect that service charge that we incurred at the bank. Finally, if we made an error, in this particular case, we're showing that we recorded a payment to a supplier. We understated that payment by $9, so our cash would be overstated by 9, and our accounts payable would also be overstated by 9. We have to make that kind of an adjustment. So here, we would debit accounts payable to reduce accounts payable by that extra $9, and we would credit cash to reduce cash by that extra $9 to fix that error. So these are the examples of the 5 types of entries that we might make from bank reconciliation procedures. So on our balance sheet, we record what we call cash and cash equivalents. Cash, of course, is money. It's what we have in the bank. It's also includes what we might have on hand. And that's checks, money orders, that type of thing, whatever. And then there's also this thing we call cash equivalents, which are the very short-term, really liquid investments that are going to mature within at least 3 months. And so those would be things like maybe a treasury bill that we buy to earn a little bit of interest, but it's going to mature very quickly, so it's easily convertible to cash, and that's called cash equivalent. So in the cash section of our balance sheet, we will show cash and cash equivalents, and then the number for the combined amount. Okay, our 5th learning objective is to understand the use of perpetual inventory as a control. Now there are ways so again, if we are selling things, we have inventory, and we have to be able to control that inventory. So we want to be able to have procedures in place so that we know whether our inventory is being stolen or misappropriated in some way. And a perpetual inventory system is one process we can put in place to help us control inventory. So let's take a look at what we need to know and understand to be able to get our heads around controlling and reporting merchandise sales of stuff. So we have to know what our inventory quantities are. So we have to have a count of all of our inventory items. We have to know what the cost of each of those types of items is so that we can take the amount times the cost per unit and come up with a total amount that we have in inventory, and or that we used out of inventory. And then we have to know where these things go and which financial statements these things will be shown. So if we have inventory on hand that's unsold, that's an asset and it shows up on the balance sheet. However, once we sell inventory, that's actually a cost of goods sold, and it shows up on the income statement. So unsold inventory, balance sheet, once it's been sold, it's cost of goods sold, it shows up on the income statement, so we have to remove it from the balance sheet and show it on the income statement in the period that it was sold. So one system we can use to help us control inventory is this thing called a perpetual inventory system. Now we can account for inventory either using a perpetual or a periodic inventory system, and we'll talk about periodic in a second. In a perpetual inventory system, inventory records are updated every time you make a sale. That's why barcodes are such a cool thing in terms of helping control inventory, because all you do is you scan a barcode. It records the sale into your system. It also records the reduction in inventory and the cost of that sale in your system as well. If you have an item returned, it gets scanned, and that goes back into your system, into inventory, and again taken and put into either sales, returns, and allowances, or however it is that you decide to account for that stuff. So, so the perpetual inventory system perpetually tracks inventory, keeps it up to date every time there's a sale, and that's a very good control mechanism, because then we can count inventory, compare it to what should be there based on the perpetual inventory system, and tell whether there's any inventory loss or leakage. And if there is, then we can investigate why. Now, a periodic inventory system means what it says. It means we count inventory periodically. We take what we had as the previous balance, we add what we purchased, we count what we've got now, we subtract that, and the difference is what we sold. Now, that might not be the case, because if we lost inventory in between through theft or some other reason, we would have to count it as sold, because we haven't been tracking inventory except for the times that we counted. So the difference between the periods where we count, we assume, is inventory that was sold. And so as you can see, that doesn't give us a very good control over our inventory, because somebody could be taking stuff in between and we wouldn't know it like we would with a perpetual inventory system. So again, a quick comparison of these methods. With the perpetual inventory system, it's tracked continuously, so then when we finally do a count, an inventory account, a physical count, and there's a difference, we can tell what that difference is. It's called shrinkage. It could be from theft or loss or even evaporation, who knows. In a periodic inventory system, we don't keep up to the minute records, and so all we can do is we can count it every once in a while, and the difference between what we had, what we bought, what we sold, and then what we have left, we have to, or excuse me, the difference between what we have, what we bought, and what we have left, we have to assume is what we sold. We can't tell whether any of that was from misappropriation or other types of shrinkage. So there's much better control through a perpetual inventory system. So our sixth learning objective is to analyze sales transactions under a perpetual inventory system. What that means is when we record a sale, we're also going to record the cost of that sale. So each of our sales we will think of in terms of two accounting entries, two bookkeeping entries, to record both the sale and the cost of the sale. And that'll be important as you go into recording these transactions. So remember, when we're doing perpetual inventory, we are doing two entries every time we make a sale. One to record the sale and one to record the cost of the sale. So merchandisers, in other words, those who sell things, earn revenues by transferring ownership of their merchandise to somebody else. And they either sell these things either for cash or on credit. Now, that transfer of ownership is an important thing, because that's when the sale gets recorded. Okay, so if you're shipping goods to a customer, you have to determine a shipping policy, and that's when the transfer occurs, and accordingly when you can record the sale. And there are two possible times on this. One is called FOB shipping point. FOB stands for free on board. It's just an old shipping expression. And so what FOB shipping point means is if your shipping point is your loading dock, once that box gets placed on the loading dock or in the truck, it is now the customer's goods. That's when you record the sale and the cost of the sale. The other is FOB destination. That means title doesn't transfer until the goods actually reach the destination. In other words, the customer. And think about it, there are also liability issues here. Who's responsible for the stuff depends on whether you're selling FOB shipping point or FOB destination. And you and your customer have to decide on that. So now we'll go through several types of sales transactions just to illustrate all these things. So remember, I said every sale when you're dealing with merchandise has two components. One is to record the sale. Selling price is what we use to record the sale. So we debit cash for the amount of the sale and we credit revenue for the amount of sale. And then we record the cost of the sale. Now, we don't use the selling price for the cost of the sale. We use the inventory cost for the cost of the sale. The difference between those two things is a gross profit. So remember, when you record the sale, cash debited, sales revenue credited, you use the selling amount. When you record the cost of the sale, you use the inventory cost. You have to remember that. It'll make your life a whole lot easier. And again, also the difference between the revenue amount and the cost of goods sold is what we call gross profit. So let's assume that Walmart sells 2 Schwinn mountain bikes for a total of $400 cash. So they sold them for $200 a piece. The bikes had previously been recorded in inventory at a total cost of $350, so $175 each. So we sold the 2 bikes. Number one, we have to record the sale using the sales amount, and we have to record the cost of sale using the inventory cost. Okay, so let's look at those entries. Debit cash, because we sold them for cash for $400. We record the revenue from that sale of $400. Second entry, debit cost of goods sold, that shows up on the income statement, $350, that's the cost of what we just sold. Credit inventory to reduce the inventory for the amount of the inventory we just sold for $350. So unfortunately, when we make sales to customers, it's not always just a simple matter of making the sale. Sometimes we accept returns for something that's either damaged or otherwise unsatisfactory. Or sometimes a customer just changes their mind and wants to return the merchandise. So we either return, we give them a full refund, or we can ask them to keep the stuff for reduction in selling price, and that's called an allowance. And so we'd say, well, okay, it wasn't what what it looked like in the catalog. If we gave you 50% credit, would you keep it? And they say, yeah, that's called a sales allowance, and we would have to record that as well. So now one of the mountain bikes is returned. It's like new, so we're going to give them the refund and take the bike back into inventory. So the analysis of that transaction is the sales return is recorded, once again, with 2 entries. One to record the sales return, where we use the sales price. The other to record the inventory return, where we use the inventory cost. So we debit sales returns and allowances, which is a contra account to sales. So it is offset sales. This allows us to keep track of the amount of sales returns and allowances that we do. And we credit cash to show the cash refund. Second entry, we show the bike going back into inventory by a debit to inventory, and we reduce the cost of goods sold because it is no longer a sale or a cost of sale. So we credit cost of goods sold, which has a normal debit balance, for the cost of the inventory. So now, a tool we use to sometimes get our customers to pay us quickly is this thing we call sales discounts. When we are selling on account, in other words, when we're recording receivables, allowing customers to buy from us on credit, we want that money as soon as we can get it. So we will oftentimes give them a little bit of a discount if they pay us within a certain number of days. So that discount, let's take a look at the purple box where it says 210 net 30. That means if you pay us within 10 days, we're going to give you a 2% discount. If you don't, you have to pay us within 30 days anyway, and you won't get a discount if you wait past the 10 days. And so the maximum credit period is 30 days in that case. The net means you have to pay us what you owe us by the 30th day, by the end of the 30th day. So we have this thing called a discount period, which is 10 days, and we have the total credit period, which is 30 days. So now we know, we will take a look at how to record those. So let's take a look at selling something on account. We sell printer paper to a local business for $1,000, premium terms $210, net $30. The paper cost us $700. That's the cost of the inventory. So again, 2 entries, or the sale at sales price, cost of sales at the inventory cost. So we debit accounts receivable because we sold it on account for $1,000, the sales price. We record sales revenue, $1,000, the sales price. Second entry, record the cost of goods sold, debit for $700, the inventory cost. Credit inventory, reducing that asset, $700, the inventory cost. So if the customer takes advantage of the discount, they're going to send us a check for less than what we've recorded in receivables because they're going to take the discount. So in this case, the sale was for $1,000, the discount was 2%. That means the customer is entitled to a 20% discount if they pay us within the discount period. So they do, they send us $980. How do we record that? We debit cash for the amount of cash that we actually got, $980. We credit accounts receivable for $1,000 because they have met their responsibility, so we have to remove the receivable from our books. That $20 difference is recorded as a debit to sales discounts, which is again a contra account to revenue to show that our customers took a $20 discount. So again, debit cash for $980, the amount of cash that we received. Debit sales discounts for the amount of the discount, $20. Credit accounts receivable for the $1,000 that we recorded originally. So again, to summarize, the sales returns and allowances and the sales discounts that we looked at are recorded using what we call contra revenue accounts. Those are offset accounts to our revenue. So you can see here how those are displayed on our income statement. We show sales revenue, and then we subtract from that these contra accounts, sales returns and allowances, and sales discounts to show net sales. So that's how the new section in our income statement is going to look when we're dealing with sales returns and allowances and sales discounts. Okay, so our final learning objective for this topic is to look at a merchandiser's, or to understand a merchandiser's multi-step income statement. What's different about a merchandiser's income statement is that we have to consider cost of sales in that income statement. So we're going to look at revenue minus cost of goods sold, gives us gross profit or gross margin, and be familiar with both of those terms because they're used interchangeably. And then we subtract expenses like the rest of our multi-step income statement was before we looked at the merchandiser. So here's an example of that change in our income statement. Here we're looking at comparative multi-step income statements for Walmart. We show sales, then we subtract cost of goods sold, which is the cost of the inventory related to those sales, and we show this thing we call gross profit. Now, a very important measure for these retailers is gross profit percentage. Our gross profit percentage is our gross profit divided by net sales times 100%. So in other words, we're looking at the profit. So we take in for 2009, the 99,449 divided by the 405,607, and that will give us our gross profit percentage. Again, understand the importance of that gross profit percentage. You can see how it's been calculated here for Walmart from year to year. It allows us to analyze or understand how well we've been able to control our prices. In other words, get a higher price or get the best price we can get, and compare that to, in comparison to the cost of our inventory. So that gross profit percent is a very important measure to see how well we're able to maintain our prices and also control the cost of our inventory. So we look at that from year to year to compare it to ourselves or other companies in our industry. Now, this other thing on the right is kind of an interesting comparison too, because it shows us how we can look at it, different industries and what kind of normal or average gross profit percentages are in those industries. If you're looking to do an industry analysis, that would be something you'd want to know. So you would look at Walmart compared to retail industry, and retail, whatever business they happen to be in, and then see how they're doing compared to their industry as well. Okay, now go ahead and just take a look at some of the solved exercises for this problem, and make sure, or this topic, or these topics, and make sure that you can apply the concepts.